Today we're diving into a really high-energy analysis report on Navitas Semiconductor.
Yes, it charts that incredible rally driven by its gallium nitride tech and all the buzz around a potential short squeeze.
The energy is fantastic. It really captures that comeback story of 2025, but we see three, I think, pretty significant opportunities to make it even more robust for a sophisticated investor.
Absolutely. It's built on a phenomenal foundation. The core idea, gallium nitride powering the future of AI data centers, that is a legitimate, powerful thesis.
So let's get right into it. The first point is a structural one. The report currently relies very heavily on speculative mechanics, namely that short squeeze potential.
Right. And in doing so, it almost overshadows the fundamental technological argument, which is, the real long-term reason to be invested.
I get why the squeeze gets so much attention, though. A 35% short float? That's exciting stuff.
Oh, it's definitely exciting. It's immediate. It promises that explosive move. But dedicating so much of the analysis, especially phase 3 and the conclusion, to price targets of $10, $12, or $15 based on a squeeze, it just reframes the whole story.
It makes the core tech, the secret weapon as it's called, feel like it's just there to support a trade.
Exactly. The tech becomes secondary to the trading mechanics, rather than being the fundamental driver of the investment itself.
So let me just push back on that for a second. Isn't that the hook? Isn't that what appeals to the aggressive growth trader who's driving the stock in the first place?
It is, and that's the crucial trade-off. It really depends on the report's ultimate goal. If you're aiming for a quick trading thesis, then sure, lead with the hype.
But if the goal is a credible, long-term investment case?
Then you have to rebalance. The suggestion isn't to remove the squeeze angle entirely, but to shift it. Move it from a standalone hype phase to more of a secondary catalyst, an accelerant.
Okay, so the technology is what earns the investment. The short interest just potentially speeds up the timeline.
That's a much more robust position, isn't it? So for some concrete examples, the intro needs to lead with the unique power handling capabilities of GaN.
Before you even mention the short interest numbers.
Right. Prioritize the fundamental shift in the company's business first. Set the tone that this is a deep dive into tech meeting a massive market demand.
And what about that squeeze setup section?
You could restructure that entirely. Instead of framing the short interest as fuel for the bulls, frame it as a massive risk for the bears.
Oh, that's a clever reframing.
It reinforces confidence in the core story. You're essentially telling the reader, the fundamentals are so strong that anyone betting against this is on the wrong side of history.
It flips the script from a plea to join a rally into a confident statement about the market being wrong.
It does. And finally, on those price targets, $10, $12, $15, don't present them as just squeeze targets.
Anchor them to business realities.
Exactly. Present them as valuations the company will reach when it hits profitability, when those big hyperscaler orders come through. It gives the whole thesis a much stronger foundation.
And that commitment to a fundamental thesis has to come with transparency, which I think leads directly to our second point.
It does. It's about how the report handles the critical cautionary data.
Right, I saw this. It does mention the company is burning cash, and it points to the red flag of insider selling. I think it was December 2025.
But it saves all of that for a brief reality check at the very end. And by isolating it like that, it kind of diminishes the report's objectivity.
A sophisticated investor reads that and wonders, why am I only hearing about this now? It makes you question why these details weren't used to explain, say, why the stock was at $1.50 in the first place.
It can make the caution feel like an afterthought, almost like an obligation rather than part of the core diligence.
But what's the risk if we bring it up too early? Don't we risk killing that high-energy narrative right out of the gate, sounding defensive?
That's the key. You don't present it as a deterrent. You integrate it as context. When you're talking about that amazing rally from $1.50 to over $7, that's the moment to bring it in.
You introduce the cash burn as the reason it was trading at $1.50.
Precisely. You frame it as, look, this was a high-growth company spending aggressively on its future. The market priced it for that risk.
So you're saying the price then was fair for a company in that phase. The price now reflects the market's belief that profitability is right around the corner because of the AI pipeline.
It builds so much more trust, and you have to do the same thing with the insider selling. You can't just drop that red flag in at the end.
You have to tackle it head on. But how do you counter that immediate suspicion that insiders are selling because they don't believe?
You ask the question for the reader. Are they selling because they've lost faith, or are they simply realizing some profits after a massive multi-bagger run while still holding the vast majority of their stake?
And you focus on the timing and the proportion of shares sold.
If the context allows for it, yes. You turn it from a scary, unmanaged risk factor into a contextualized detail. It goes from red flag to, standard portfolio management after a huge gain.
That level of transparency is what really separates a professional analysis from just another retail hype piece.
It shows you've considered the counterargument and still believe the core thesis holds. Okay, so that brings us back to the core thesis itself, the technology.
Right. The report uses this great analogy. Legacy silicon chips are old, reliable sedans, but GaN is the high-performance Ferrari. It's vivid. I like it.
It's a great analogy. But for this kind of deep dive report, we need to move beyond analogy and into technical necessity.
Okay, so the argument currently rests on these big, powerful claims like, you can't have AI without power, which is true, but
It's missing the quantifiable so what. It doesn't quite establish why Navitas' specific chips are so indispensable for that critical 800-volt architecture that NVIDIA and the big hyperscalers are moving to.
So we need to connect the dots more clearly between GaN superiority and the demands of next-gen AI. Just saying there's a partnership isn't enough.
Exactly. We need to bolster that secret weapons section with some actual quantifiable metrics. Something that moves the discussion from just, it's better, to it's functionally indispensable.
And the focus really has to be on that 800-volt range. That's the whole game right now for data centers trying to manage these insane AI power loads. Legacy silicon just can't handle it efficiently.
That's the critical context. So instead of just general claims about cooling or speed, you introduce concepts like power density or switching frequency.
For instance, you could mention that Navitas' GaN chips offer, maybe a 40% reduction in power loss, or can operate at frequencies that silicon just can't touch in that 800-volt environment.
And why is that so critical?
Because in a massive data center, a 40% reduction in power loss isn't a small saving. We're talking about potentially billions of dollars over the facility's lifetime, not to mention the huge reduction in cooling costs.
That's the translation right there. You take a technical spec, higher switching frequency, and you translate it directly into a massive, undeniable economic benefit for the customer.
And that is what justifies the market's current valuation. It's completely independent of any short squeeze. It secures the core thesis.
It makes the claim Navitas makes the chips that handle that power efficiently demonstrably true, with data, not just with a good analogy. The connection has to be crystal clear. GaN isn't just a nice-to-have. It's structurally necessary for the next wave of AI. That's your moat.
So let's wrap this up. This is already a very high-quality analysis.